Well, we begin this half hour with Wall Street's historic highs. Markets closing solidly yesterday. Pretty nice move. The S&P 500 setting an all-time record. The gains coming amid signs the Federal Reserve is moving toward an interest rate cut. Joining me now, Mahoney Asset Management CEO Ken Mahoney. Ken, what do you make, first of all, this market, this rally? I thought yesterday, for instance, was phenomenal, right? Because Lindsey Graham almost destroyed the rally with that tweet. Ironically, President Trump, the hawk, talked it back up, and now
a tweeting war, exactly.
And now, of course, everyone's sort of looking at the Fed to be our friend.
Yeah, look, I like what's happening here. Color me a bull. I'm in the bullish camp. But, we've gone too far too fast. Come on, let's face it. A couple weeks ago, Dow's at 25,000. Here we're at 26,700. I mean, without even a breath.
So someone
to go back and fill a little bit.
Say, sell your stocks?
No, trim a little bit. There's nothing wrong with trim a little bit. Look, sentiment goes wildly bearish like it did when China and U.S. couldn't get it together. And then we go wildly bullish this way because the Fed's going to cut rates. And by the way, this cycle, like, us looking for investors, hoping for weak news so they can cut rates, that's not the best cycle really you want to be in. I don't really like when we have to kind of encourage, oh, great, we have bad economic news, right, they're going to cut rates. I don't like that cycle necessarily.
Although, listen, we are at record highs, right? And right. If throughout this whole seesawing, if people had kind of, been selling on these headlines or trying to avoid these dips, they might have missed out. But what about the notion that Powell may be looking not necessarily for weak news, but to actually prevent that weakness? Buller referenced low inflation. Right. At the FOMC, their inflation, their PCE inflation went from 1.8 to 1.5.
Right.
Powell in the press conference also said this drifting inflation, drifting lower and lower, is difficult to arrest. I thought that was a key thing.
Right.
I mean, we know deflation is far worse than inflation.
Right. And look, to get in front of deflation is easier. We learned that in 2008. Get behind the curve. It costs trillions of dollars to bail it out instead of getting in front of it. So that's what the markets, kind of reinforce, that we can actually have a decent economy, slowing down a bit, yet the Fed could still be supportive and cutting rates. But come on, guys, it's been a Dr. Jekyll, Mr. Hyde type of Fed policy, right? October 4th, far away from neutral, to December raising rates and talking about hikes in 2019, and now we're talking about cutting rates. So, I mean, this has been all over the place, and it's hard for investors. That volatility we've seen in the market has been the policy making of the Fed kind of weaving in and out of all this.
What about beyond the headlines, beyond the Fed, beyond trade, and just the fundamentals?
Yeah, the fundamentals are strong here. We like them. And especially, again, if you want to start doing some nibbling, again, we encourage a little bit of selling here. Just, take some shekels off the table. But, again, we have a really good blueprint of what's going to work. We have stocks that have guided higher throughout the year. We have earnings season coming up. Those are going to be the go-to stocks again, go-to companies. Companies like Microsoft, I think of Salesforce and these software companies who beat estimates in the first quarter and raised guidance. And those are the names you want to be in, those companies that raised guidance.
Okay, so I'm wondering about the source of your bullishness. You're talking about not a bad economy,
right.
Some bad signs, but generally pretty good.
Yeah.
Do you assume this China trade fight gets resolved soon, or you feel like whether it does or not, this is still a pretty good economy?
I think it's a pretty good economy. I think we get a partial fill. I've been saying on record for a long time, we're not going to get the full Monty. I don't see the Chinese government, quite frankly, cracking down on companies that invade our intellectual properties. I don't see that. I mean, so I think it's going to be a partial fill. Something where China can walk away from the table and say they got to win. Something where the president say they got to win. But I don't think we get everything that we're going to want. But I think overall, even without that, I think the economy could still be pretty strong.
Ken, how do you see the U.S.-Iran tensions playing out? When the U.S. has gone to war in the past, military conflict can be stimulative, but you've got a country that probably really doesn't want that conflict right now. What are your thoughts?
Yeah, my thoughts are hopefully that you put enough pressure on them that we don't escalate this thing to a war. We tried sanctions. That doesn't seem to work. But certainly if they're going to start, shooting down things and hitting things, I know the president's not going to have a high tolerance for that, and then we'll attack. So I think the ball's really in Iran's court. Right now they got the message, stop playing these games. But should they escalate it, I do think, unfortunately, that we will have a military conflict.
All right. So I want to bring this up because more American companies are now speaking out against tariffs against China. Apple's on the list, Dollar Tree, Keurig, a whole bunch of them have joined. This is trade talks between China and the United States are going to resume next week at the G20 meeting. Ken, for me, I feel mixed on this, because when these companies, I never really hear them say anything about China having 1 million people in prison camps or learning camps because of their religion, of the brutalness that they've shown to Tibet, of the lack of freedom of speech, of stealing $200 billion a year in intellectual property. I could put a hot bear on Etsy, and if it's hot enough, a knockoff version will come out of China a week later. I never hear these companies talking about that. I know they're trying to protect their bottom line, but, if everyone's got skin in the game, if it is indeed a trade war, right, How about putting your multi-billion-dollar buyback on the side for a second? For 1 quarter. For 1 quarter. I bet you GameStop wish they put it aside forever because they put, they're about to go bankrupt and they bought $2 billion of a stock that went from 60 to 5.
Good short.
So why not be more supportive of this?
So, look, I think the silver lining in all this, hopefully companies diversify away from China. So you have companies that have 90% of their imports come from China. That's probably not a good strategy they've learned, right, with the tariffs and who knows what else is down the road. Maybe they go to Vietnam. Maybe they go to Taiwan. Maybe they start manufacturing and hopefully bring some manufacturing back here to the U.S. But my point is maybe the silver lining is because of this feud, companies are now going to look to diversify their sources and their suppliers.
Well, we've seen a lot of that. Vietnam and Mexico, I think, is the big winner so far. I mean, they really have done extraordinarily well. And that's one of the
that's a silver lining, though.
That's one of the reasons I think they passed USMCA quickly.
But stock buybacks, are you kidding me? This is the go-to. This is how we kind of get those EPS numbers look good.
When Joe Biden announced his first official campaign speech, he mentioned stock buybacks. I'm not against them, but I am against them when you have a failing company or a company that's stumbling, and somehow CEOs and executives are being paid in that stock that the company's buying back.
But those are the companies you want to be buying back instead of blowing it on bad investments that they don't know how to make.
But GameStop
right?
is a good example. GameStop, they started buying their stock back big time a few years ago at 56. It's about $5 or $6 right now. 2017, the CEO's compensation was $6.5 million. Over $4 million of that was stock. That's nuts. And a company that was laying off people, closing stores, and the future was there. They knew what the future was. They should have been investing that into a digital formula, but they didn't. Look at that. We've got it on the board. $5. They started buying it at $56 a share. I think that was a terrible decision.
It was a good short for somebody along the way.
You bring up a great point, though, Charles, because one of the criticisms of the president's tax cut was that companies are using this money to buy back stock instead of reinvesting it, which is what the goal would be. You can't tell them what to do with it when they're saving money, but that definitely has been a trend.
By the way, $770 billion brought back in the first year from overseas, so that wasn't bad. Ken, we hit you from every angle, my man. Thank you.